Hello friends, let me ask a simple question. Suppose you invest in a mutual fund through SIP or in a recurring deposit where you have to pay money at some interval and then the amount of money that you have invested starts earning a return. So, do you know how to calculate return in this scenario or how to calculate return in any portfolio? Don't worry, we will learn everything in this video. So sit back, relax and enjoy the learning. But before going to the solution directly, let's see different type of returns that investors calculate in their portfolio. So we will start with the most basic one, which is absolute return. The formula for absolute return is pretty basic. It is calculated as the difference in the amount divided by the initial amount. He is Devers who has invested 2 lakhs in fixed deposit which gave a maturity amount of 2 lakh 20,000 post a year. So the absolute return calculated would be the difference, which is 20,000 in this scenario, divided by initial amount, which is 2 lakhs, which come out to be 10%. There are few points worth noting about the absolute return. First, it is not suitable for measuring different time frames, meaning it does not consider time frame in the calculation. So it just tells you, let's say 10% return, but it won't tell you whether it's a year return or a 5-year return. Secondly, it does not compare return against any benchmark. So generally while investing, we have a benchmark. Like in case of equity, we want to beat Nifty or Sensex. But we don't have any benchmark as such to compare in case of absolute return. Thirdly, it does not consider inflation into calculation and thus the absolute return calculated might not be the real return which is inflation adjusted. Fourthly, it does not consider the risk of investment profile into consideration and thus though the return might be same for the different investment but the risk associated with the investment might be different as well, leading to taking wrong investment decisions. And lastly, it does not consider the role of funds manager effort like in case of mutual fund in the calculation of absolute return. So now we have got a pretty good understanding of absolute return. Next, we will see other type of return called CAGR, which stands for Compound Annual Growth Rate. CAGR measures the investment's average annual growth rate over a given period, assuming profits are reinvested at the end of each period of the investment lifespan. This is more of a jargon now. We will look into this with an example, but before, we will check the formula. The formula to calculate is shown here. So CAGR is calculated as the final value divided by the starting value to the power of 1 by n minus 1. Now let me ask you one question. Have you seen this formula before? Let's take a closer look and let's think for a little bit. Yes, this is the same formula that we saw in our first video on time value of money. The same formula have been readjusted to calculate the rate of return. He is our new friend Suresh, who has an initial amount of 20,000 and has invested in a scheme. However, his investment amount decreased to the value 15,000 in first year, then increased to 18,000 in the second year, and finally became 30,000 in the third year. So using the formula, we can calculate CAGR as the final value, which is 30,000, divided by initial value, which is 20,000, to the power of 1 by 3 minus 1, which comes out to be 14.47%. Now, a very important question. What does 14.47% signify? So remember we have an initial amount of 20,000 and let's assume that the rate is 14.47%. So let's calculate the amount at the end of first year by using the future value formula that we have seen in the first video. So we get 20,000 into 1 plus 0.1447 to the power of 1 since this is for a year, which comes out to be approximately 22,894. Now, calculating the future value of this amount, which is 22,894, at the end of second year with the same interest rate of 14.47%, it would come as 26,207. And finally, calculating the future value of this amount, 26,207, at the end of third year with the same interest rate of 14.47%, it would come as 30,000. So this means that even though the value of investment increase or decrease by a certain percentage each year, the compounded annual growth rate has smoothed out the return and provided us with one rate of return, which our initial amount compounded every year until we arrive at the final amount of 30,000. This is a very important concept that investors use when evaluating the return on their portfolio. There are some points worth noting in case of CAGR. Firstly, we saw how CAGR has smoothed the rate of return. So instead of having a different rate of return for each year to arrive at the final amount, CAGR gives a single rate of return which, when compounded, will give the exact final amount at the end of the tenure. Secondly, CAGR helps in taking better investment decisions, as this can be used to analyze the investment decision each year. So let's say you purchase a mutual fund 3 years ago, and then you calculate the CAGR for every year. And if for every year the calculated return matches your expectations, then you would like to continue your investment in the future as well. Else, you would like to reconsider your investment decisions. Thirdly, it can be used to compare returns between different funds and benchmark. So what do I mean by this? I mean to say that when you can compare your return of a particular fund with the returns of the similar fund, and thus it would help you to understand how your mutual fund is performing compared to its peers or benchmark indices. Fourth, it helps in long-term investment planning by letting you know the potential growth of your investment, and hence you will have an idea of the future amount that you would be accumulating based on the CAGR. However, one important point to note here is that CAGR does not consider the investment volatility, and thus it is not ideal for risk assessment, as two investments might have the same CAGR, but the risk associated with the investment would be completely different. So in those scenarios, we need to consider other technical analysis tools as well, like SARP ratio, which basically gives you excess return over risk-free asset, or IRR, which stands for internal rate of return, defined as the discount rate which makes the present value of all your investment zero, etc. Don't worry if you are not familiar with these terms, because we will be discussing all this in the later videos. Next, we are going to learn about XIRR, which is predominantly used in the calculating returns of the portfolio. XIRR stands for Extended Internal Rate of Return, which is used to find returns of the multiple investment done in various point of time. Like in case of mutual fund, when we invest via SIP, or in case of recurring deposit, we invest some amount of money on a periodic basis and we get some return in later point of time. Still confused? No problem. We will see this through an example. Suppose a person has invested in a portfolio where he has to pay monthly investment of rupees 5,000 on the respective dates as shown here. So basically on 1st of March he paid 5,000, then on 1st of April he paid again 5,000, next one he paid on 11th May, and then next one on 21st of June, and finally on the 1st of July, and later he got the amount of 26,000. So to calculate the XIRR, it's very easy in Excel. So Excel has inbuilt function XIRR which takes two parameters, values and dates, as shown in the formula section in the image. And once you give the input, it calculates the actual return. This method is commonly used to calculate the return in case of mutual funds or recurring deposit. And this is the answer to the question which I asked in the starting of the video. 2 points worth noting about XIRR is that it needs a accurate cash flow, and it is sensitive to the small changes in the values or date, as changing dates or values will give a different XIRR. So guys, that's it for this session. Please do like, subscribe and share the channel. Grow your finance with your friends, colleague and family, and stay tuned for the next one.